Coverage you can count on continues with Gina Glaros.
Many are still keeping their eyes on the stock market and their money after weeks of unknown. And this morning I'm joined by Edison Bazika with Hefty Wealth Partners in Fort Wayne to talk about how this affects your paycheck. Thank you so much, Edison, for coming in.
Here.
Always a pleasure. Well, first off, let's talk about that stock market crash that happened a couple weeks ago. How shocking was it?
Sure. So in terms of shock, there was a lot less of a shock effect if you actually looked at the data. Over the past 4 months, we've been extensively writing in our economic and investment commentaries that something like that was imminent, kind of looking at the risk data, looking at the overbought conditions of the market. So shock factor was there if you were prepared. We were able to actually be prepared for the downside, actually took advantage of it as an opportunistic play for us. And, the main key there is if you were shocked, you weren't prepared, and being reactive to your shock is probably the worst outcome to your overall investment goals.
Okay. So how do you be proactive?
Sure. The way to be proactive is actually working with a financial advisor, working with an investment professional, and kind of realizing that the buy and hold approach or the kind of look at it only once every 3 to 4 months approach may not be the best way to do it. Always being kind of understanding what's going on in the market, kind of understanding how your investments are structured, why they're structured like that, and always knowing, if something like that were to happen, how do I take advantage of it? Because, sitting in the background and being worried about it is probably less beneficial to you than maybe putting some money back into the market and being proactive that way.
Sure. The entire world has been waiting for the Federal Reserve decision last Thursday,
Thursday,
was it?
Correct, yeah.
On whether or not they will raise interest rates.
Correct.
How, depending on the decision, how is that going to affect folks?
Sure. So the Federal Reserve did not raise interest rates on Thursday.
Oh, that's right. Yeah.
There was a big anticipation that they were going to raise about 0.25%. So the whole effect there, kind of 0.25% in retrospect is a very tiny amount.
Okay.
But should that happen in December, I think lending costs for retail investors, whether it be for a house or a home and the such, may rise. I think the most important thing to keep in mind from a consumer standpoint is that irrespective of what happens, a rising interest rate environment is actually indicative of a stronger economy. So we would all be better off in the long term if those rates do rise slightly, because in our view, not raising interest rates bears higher risk than actually raising interest rates slightly, as it means for better labor market growth and the such. So we're looking for a December rate hike, minimal, yet a rate hike happening in December.
What's the current interest rate right now?
It is 0 to 0.25% is the federal funds interest rates range, and that could rise about 0.25% additionally in December.
Okay.
Yeah.
For more information, how should folks get in touch with you?
So on our website, www.heftywealth.com, we have all our commentaries, we have all our economic analysis, and we'll find our entire team on there as well as my email address, and contact me that way.
Okay.